Congratulations, you survived another FOMC. What a week it has been. Let's start off with year to date performances. SPY down 21.22%. QQQ down 34.11%. IWM down 20.7%. And Dow Jones down 11.36%. Everything is still bearish trend. We have not seen a major shift in any trends. So yeah, what
Yeah.
a week it has been.
Overall markets are we saw a little rebound after a little dip and following into the close on Friday, a little rebound after the FOMC release. We're gonna see how that trades into the coming weeks.
Yeah,
We have midterms coming up, right? And CPI next week. So we'll talk about that in a little bit, but that's something we have to pay attention to.
yeah. So we are still in stagflation. Our system has indicated an increase in inflation. So inflationary odds are actually the highest now, but at a very low confidence rate. So that's why we remain in stagflation. The system has not pivoted to an inflation regime just because things are starting to show an increase in growth. The overall market itself starting to show an increase in growth, which is what's propping up that inflation number. But it's not a broad increase. So that's why the system strength is still so low.
Right. And the stagflation signal we're seeing right now is not a preference that we hold. It is the actual regime calculation. It's not biased. It's not sitting there waiting for us to change it. It's math, right? So it's telling us that we're in stagflation. And the under the surface, we have an inflation trigger with extremely low confidence. If the confidence picks up, we will shift from stagflation to inflation. But until then, risk off it is.
Yep. Still holding cash. Our portfolio is net short with leverages. So let's look at next week. It's pretty uneventful until Thursday. So Monday, we've got Fed speakers. Tuesday, we've got no market moving events. Wednesday, we've got EIA petroleum status report and another Fed speaker. Thursday is going to be the big day everyone's waiting for. We've got Fed speakers, CPI, and jobless claims. Then we've got more Fed speakers, EIA natural gas report, Treasury statement, and the Fed balance sheet. Friday, we've got consumer sentiment. So Thursday is going to be the big day coming up next week. Pay attention to that. We also will be paying attention to what the Fed speakers say. It's usually the more they talk, the worse things get. So we'll be paying attention to that.
Yeah, and obviously you can see we have a flood of speakers coming in just the week after FOMC. So we're going to see what they have to say. And we'll go over a little bit of what Powell said in a few minutes. But let's go over the other major economic releases of the week. So we had ISM manufacturing PMI. We see a new lows here of the year and on a steady decline since the start of the year. We're now on the brink of breaking 50. We have JOLTS, and they are on a year-over-year basis. The ROC is flirting with zero. Openings are still holding up, which are signaling that the jobs market holds ample opportunity and remains rather tight. So again, we're not really seeing these prints fall apart, which is what we see in a real recession. And we're still getting that signal that the labor market has some room to go. The United States ADP employment employment change came in with the third higher consecutive print in positive territory, and we're off the lows of the year, signaling again labor market remains tight. We had the crude oil inventories big downside print or did big downside miss, excuse me, this week, and it's the third consecutive negative monthly close. And more negative prints mean more upside pressure on energy. And I've said this a few times now, where it's more about the group of where these are printing than the actual prints themselves. The more that these start printing positive, the more downside pressure there is in energy, and vice versa. It's when we have a lot of negative prints that we start to see a fuel in energy prices, a lot of consistent negative prints. And we're starting to see that again. So be on the lookout for a potential pivot in energy from or crude oil specifically into bullish trend. If that happens, obviously that'll just be more power to the inflationary regime pressures that we are seeing under the surface. We had the United States initial jobless claims closing the month off both the March and September lows. So we're off the March and September lows, but we are still under the July highs. And this is still quite a ways from going back above where we opened the year. Excuse me, where we were last year at this time. So last year at this time we were somewhere around 240. We're at 217 right now. So we have to go above that and above the July highs to really put any upward pressure on jobless claims, and that's again signaling that there's minimal stress in labor markets at the moment. Until we start to see this pick up, it's hard to get all bearish on the economy. And that's what the Fed is trying to do. Remember, they're trying to achieve maximum employment with price stability. Well, if prices aren't stable, they're going to have to let maximum employment slide. At least that's their fundamental thinking. So we had the United States non-manufacturing PMI steadily falling towards 50, with this being the lowest print since 2020. And we're still quite some ways. We still have some quite some ways to go until 50, where an official contraction begins. So remember, with PMI, anything above 50 is considered expansion. Anything below 50 is considered contraction. We still got quite some ways to go. So it's going to be a while unless there's some rather crazy negative prints here that will start to see a contraction in non-manufacturing PMI. But on a print basis, we are seeing a decline off of last year's highs rather steadily. And we had the United States non-farm payrolls come in at 261,000. This is the lowest print of the year, but it's still well above zero as the tightness continues. And we have a negative 17% change from last month, but again, still in positive territory. So something to watch here. Obviously, with this remaining tight, a high, labor markets remain tight. And that brings us to the final unemployment rate. It came in at 3.7%. So we're back to August levels, but we're still off the highs of the year. So in January, we um we were printing 4%. So we're not even at January's levels. That's going to be something that we have to watch obviously closely, because unless this really starts taking off, the Fed is going to think that they have more room to run. Now, while again, this may not be the accurate representation of the economy, right? To say like unemployment rising is something that the Fed is going to, or I should say, maximum unemployment and price stability, those correlations. But that's what the Fed is going to follow and execute, because those are their mandates. That's what they believe they are here to do, or their mandates are. So they are going to do that. So if they see employment at a maximum and price going the other way, they're going to try and break one to fix the other. So basically, the Fed's going to try and break unemployment after they tried to save it just a little over 2 years ago. So something to watch as we go into the coming months. Let's go into ES. So
Yeah. So surprisingly, not a massive sell off after what Powell said. Powell basically saying, I don't know if you guys saw, but there was a question asked saying markets are rallying right now based off of what you guys are saying. And Powell came out and completely shut it down. That's when we saw the reversal on Thursday.
yeah,
Completely shut it down, said markets should not be. Basically, this is not word for word, but he basically said there's markets should not be buying into this. Like, get the fuck out. That's pretty much what
pretty
he said.
pretty much. And there's something that I want to clarify here before we go into discussing today's topic and bonds themselves. There is a difference between rate hikes and pauses. Okay. So when you understand what the Federal Reserve is going to do, right, which we can see by by the forwards curve and the Fed funds futures, they're going to continue to hike. There's a difference between those rate hikes slowing right? And pausing. That's the key difference. So you can continuously hike at a slower pace. Pausing is a different story. You are no longer hiking at all.
Hmm.
So if we look at the way the Federal Reserve has been enacting policy up until now, talking 75 basis points, 50, 75 basis points pretty much consecutively now. That's obviously not going to be the norm for the next 12 months, right? You can't go 75,
I
75.
mean,
You know,
I
you
hope not.
well,
that
well,
that would
let's
not be good.
let's look at what the bird's eye view of what the Fed funds futures are telling us, right? We have a 5 and maybe a quarter percent terminal, right? So 5 and a quarter is where we're sitting at right now, roughly, and the EFFR is at 383. So think about the difference from 383 to 5 and a quarter, right? How many 75 basis point moves is that, right? If you really, well, we don't, it's not going to be consecutive 75 basis points. They're going to have to slow the rate hikes maybe down to 50s and then 25s at some point to get to the terminal. Now, there's a lot of verbiage that was coming out of the Fed, even the speaker saying that a lot of the front loading's been done, where what they're saying is the amount of rate they've gotten the ball close enough where now they can go inches.
Hmm. Yeah.
So like they've gotten us close enough to that terminal rate where they can like hike into it slower. The only problem with that is if inflation doesn't actually cool and we start to see accelerate even more. Again, energy, as we went in the recap, if we get more and more negative consecutive prints um, in the crude oil inventories, it's going to add upward pressure to energy. If energy prices start to rise, they go crude goes bullish trend and that rips. Well, that's going to just put upwards pressure on headline, and in turn, again, it's going to fuel the inflation trade higher. So that's going to be an issue with the current terminal because the current terminal is pricing in obviously oil at or lower than where we are right now. So
Yeah.
oil turning around is going to push that terminal higher. That's what's going to happen. Now, again, there's a difference between pausing and slowing, right? So if the Fed starts to slow, which it's inevitable if they're going to slow, we all know that. If we look at the Fed funds futures curve, I can tell you that they're going to slow. It tells you itself it's going to slow, right? The amount of rate hikes is going, we can't go 75, 75. But if we were to do that, we would be at 500 basis points, way faster than May of 2023,
Yep.
right? So obviously the rate hikes are going to slow. We're not going to 20% EFFR or 10% or 15% EFFR. So the rate hikes have to slow. That's not the question. The market understands that. So when the Fed says that they are not talking about pausing, and maybe the market pulled back on that, right? Um, it, and the market didn't act so well because of how hawkish Powell was with his conference. Like the big line was Powell saying it's premature to talk of pause. That was the big line, and
Yeah.
that's where the market really had a pull back. But we already knew that.
Yeah.
Of course, it's
At the end
premature to
of the
talk.
day, the market did not sell off too much off that news. Like we literally bounced 2 days later.
Right
So
now,
it was already priced in more or less.
to, to a degree, yes,
Yeah.
exactly. So the premature talk of a pause was initially was a shocker to the market. I remember I saw the headline print and Spoos dived, and I was like, okay, I get it. I mean, people are scared, but like, what did you expect to happen?
Yeah,
Right?
it's kind of been he's been reiterating the same message for the last 6 months.
Right now, you see the market. Like, let's look at ES here. The market dove on FOMC day. The market was actually up into it ripped up first into go back to a 15-minute. The market pushed into the FOMC release and then dove. Right. So if we are looking at ES right now, we're looking Wednesday FOMC day. The next day we go lower. If Powell were to come out and say, instead of saying that it's premature to talk of pause, if he said it's premature to talk of slowing the rate of rate hikes or the rate of hikes, I think we would have been limit down,
Mm-hmm.
right? Because he's telling you that it's premature to talk of a pause, but we already knew that. Well, what the market is priced in is that the Fed is going to slow the rate of hikes. It's what the market's been telling us. Now, it's been telling us this all year, right? But the terminal's been edging higher. It was like 380, 410, 430, 450, 480. Now we're at 5. Now we're at 520. Oh, then we were at 5. Now we're at 525, right? Or 520-ish. It's it's not saying that there's 75, 75, 75, 75. It's just saying that, okay, look, think of it like a bell curve shifted to the left. So those rate hikes are really baked into the front end, and they're going to slow as time goes on. So I should say the amount of rate hikes are incrementally large. I should say largely priced in at the front end of the curve, and as we go on, they're gonna phase
So you're
out.
saying if he came out and said we're not even thinking about slowing, so that means they're going to continue doing
Right.
75 basis point hikes,
Yes.
the market would
Yes.
have reacted much more negatively to that.
Right. Because we saw the dive, right? And we saw the dive into Thursday, or you saw the dive in FOMC, the sell off in Thursday, get reverted on Friday. If the
Hmm.
market was really that scared, and this is not me telling you that we can't go to lower vamp because that's negative about almost 440 basis points from here. So that's possible. We can go there. But everything, just remember from a pricing perspective, everything the Fed had to say was said, and this was seen as an extremely hawkish press conference, right? The market is still within the range of the day that the Fed dropped the press conference.
Hmm.
And I've annotated on the chart here the Fed days range high and the Fed days range low, so we can get an idea. Look, the prices was able to close the week within that range. So if something that was said was extremely bearish on Wednesday, god awfully bearish, right? Wouldn't the market have closed much lower 2 days later?
Oh yeah, definitely.
Right? Right?
Yeah.
It's just it's an inkling. It's not me telling you like, oh, the things are look, we're hedged for a tail event to the upside. Okay. Long story short, I'm not going to go over the dynamics of the hedge. If you're in the chat, you understand what's going on. We're hedged for a move to Momo, basically. The chop here is whatever. The portfolio will suffer some sort of drawdown if this goes because the hedge will burn out, right? The hedge will burn out, and the hedge will have be at negative cost. At least a part of it. Some of it was fueled by some um, some put sales, some basically cover puts uh, that fueled
Yeah.
the call
Yeah.
spread. But regardless, there'll still be a small loss, right? And some of the shorts that we're holding, even though we're not holding options, we're holding shares of leveraged funds, which have embedded time, basically theta time decay, because of the way that their funds are holdings are structured. So the market chopping sideways for a while is not really the best for our holdings. But I also think due to liquidity conditions, it's going to be hard for the market to really chop sideways for a very long time. And we're going to go over that in a few minutes, and that's going to be the topic of the podcast. But
But yeah, let's move on
long,
to ZB.
okay, so ZB is we're looking at
Well, first of all, we've been going over ZN every podcast, the 10-year, because everyone loves the 10-year. But it's ZB is TLT. So we figured our deflationary plays, we play TMF, which is leverage TLT. So we figured we should talk about ZB instead of ZN. So going forward, we'll be looking at ZB rather than ZN in our podcasts. There isn't much of a difference. They trade roughly the same. Like as you can see, ZB is getting crushed just like ZN has been. But yeah, going forward, we'll be looking at this instead.
right, and it's important that we pay attention to ZN in general because it's the middle of the curve. But in terms of positioning structure, ZB is more efficient because it's going to reflect more of what we're talking about. And I think that's we'll go into what has been going on here. It's very similar to ZN, uh, pretty much straight down ever since the August top bearish trend. Not much different than ZN. It's in the same trend situation, but going forward, we're going to just keep an eye on this over ZN again for positioning reference if we do happen to get that deflationary pivot.
Yeah.
So let's talk about liquidity today. And I know that a lot of you guys like this liquidity index that I post, and we've gone over it briefly a few times before. but I think I want to clear up some things, especially on how this is going to, or how you can use this and understand this with the current market conditions. So before we get started, we have to understand what is market liquidity. And I've done a lot of tweets. We've done a lot of podcasts. We have a whole podcast on liquidity, but this is going to be more revamped, right? Because this is going to be putting everything into one simple understanding indicator. Now, we've gone over these components, and just to refresh your memory, it's the dollar, it's the VIX, it's the move index, it's the Fed balance sheet, and it's interest rates. All of these have a big implication on liquidity. Now, liquidity is more than what you may see on the internet when you try and look this up, where most people are going to tell you it's the spread depth between ES, it's bid and asks, right? It's the bid and ask spread depth. So if it's how many ticks is that depth? How wide is it? The wider it is, the less liquid the market is. Now, it's kind of foolish to look at, or it is foolish to look at one futures contract and determine the overall market liquidity. While ES, or the S&P 500, is the most robust index out there, it's foolish to understand that the entire market revolves around the bid and ask spreads of the ES futures.
Yeah, I mean, you're not
So
even taking into account NASDAQ when you're doing that, which is also a huge component.
yeah, I know, and I think that um, this index here is going to help simplify everything. So the index is basically putting all the puzzle pieces together that I've just listed that are major liquidity components and giving you an easy to understand model. And the model is as follows: anything above 70 is seen as illiquid market conditions. Anything below 70 here is considered liquid enough for the quote unquote trend to continue, bullish trend, right? So for the buy the dip situations, you really want to see this under 70. And that's most likely going to happen once we get a full risk on pivot with bullish ES and NQ trends. We're going to see this most likely under 70 when that does happen. But
Just for context, this chart, the purple line is VIX, the illiquidity index is the white line.
right. Oh, yeah, it's good. That's good to clarify. So now, matter of fact, why did I overlay these two? Well, typically over time, they're rather strongly correlated and they trade together. Even 2008, right? They move together. So we've seen that there's a huge divergence now. Nothing that we've seen in the last 20 years or 10, 15 years. Now, why is this so important? Well, it's telling you that volatility is not matching the illiquidity conditions in the market. And why is the market acting so illiquid? If you may think, oh well, the market's trading just fine. What does this really mean? I don't understand how this makes how this reflects into what ES is telling me today. What the illiquidity index is telling you is that the odds for a tail event in either direction are a lot higher than you would expect. Meaning, ES can rally 10-15% in this environment without an issue in a very short time. Whereas back in maybe 2021, it was more of a slow grind, right? When the illiquidity index is under 70, the market's very liquid. Call it the big boys, whatever you want to call it. They're in there with size. They're enticed to play in the playground's clean. They want to play, right? They want to deploy their capital. But when that capital gets sucked out of the market, which we're seeing now, where dollar demand is so strong, again, dollar doing what it's been doing, obviously, the market conditions are going to be illiquid. So moves to the downside and moves to the upside, or major moves, tail events, are very possible. Now, to the downside, it's very hard for me at least, to look at this and say we're going to get a major downside uh, tail event or negative print, because it's almost like, what else is going to happen now, right? We've got the Fed hawkish as can be, terminals at 525. Midterms are coming up. We'll see what happens there. But if something drastic happens, maybe that's the event.
Yeah, but
Um,
it really does feel like everything bad that could happen has already happened. And so the market's like, okay, we survived it. We're good to go.
right, and we would need another major macro event to unwind. For example, here's a good example of what I'm talking about. If the BOJ implodes, and unwinds and they dump their treasuries. They go bananas, right? That would be a macro event where a huge negative tail risk is very possible. Now, could that be a scenario that happens? Yes, but I don't see it happening just right like in the next 2 weeks, 3 weeks, a month. You know
Yeah,
what I mean? Like that,
something needs to happen for them to break like that.
right? Now, is it unfortunately, it's a lot of things that people are prepared for. They wanna position themselves to take advantage of this huge, like, doomsday event, right? And I understand it. You get it's very easy to get caught up in the weeds, right? And for a very long time, people were telling you that cash is trash, right? Especially uh, Ray Dalio. He was very key on that point. At least in the last couple of years, cash is trash. And I think he even said recently, cash is still trash. But regardless, you have to understand where that context is coming from. When the liquidity index is under 70 and near its lows, and remember what this is telling you. This is the basically telling you there's very low levels of illiquidity. So that means liquidity is high. It's a seesaw. The higher illiquidity index goes, the lower liquidity is because it's telling you that the illiquidity score is higher and higher, which means liquidity is lower, right? So when the illiquidity index, excuse me, is very low, liquidity is very high. So if liquidity is very high, cash is incentivized to take a risk wherever you want because a volatility risk is no longer there, right?
Hmm.
So when volatility risk is I don't even want to say exacerbated, it's just blown out of the water. It's blown out of the water like it is right now, right? It
Yep.
literally,
Yeah.
like we're talking ES moving in a day, right? We're talking about ES moving 2% a day, VIX 24 and a half. Like this is not normal. This is not an environment that favors um, deployment of cash because there's too much uncertainty going around with, and that you
Yeah.
could just see that with the VIX number, VIX
And
24 and a half.
that's why we could see with the reverse repo numbers as well. They're at all-time highs, and that just kind of says something. If you think cash is trash, look at the reverse repo numbers. The big dogs, the people with money, the people that know what they're doing, they're in cash right now, giving their money to the Fed to get interest rates. That's what they're
Right.
doing right now, and so that does have a weighing in this illiquidity measure here, and so you can just kind of see that cash is not trash. The big dogs are in cash right now, and there's really no reason to not be in cash.
Right, and there's a difference in stating that cash is trash generally, right? Some people will say cash is trash forever because the government will always devalue it. I understand
Yeah, but I mean, your stocks are devalued 20% right now. So,
that.
I
Yeah,
mean, and the dollar that they're valued in is also devalued. So you're kind of getting a double devaluation at that point.
yeah, and the big key is in this whole thing with the cash being trash, especially now, is not that or that statement now is not that cash is trash now. Um, Cash is trash in risk on environments. If you break down the understanding of the regime model, risk on and risk off, just those two risk differentials, you'll understand that in a risk on regime, cash is trash. Unfortunately, for the cash is trash mentality, or I should say, fortunately for the cash is trash mentality, risk on regimes are more prominent than risk off regimes over time. That's why the market goes higher than it does lower, right? So, if you hold this idea of cash is trash over the long term, you're going to be better poised than cash is not trash, right? Holding dollars for the long term.
Hmm.
The problem is people cannot differentiate when to make that decision. So, they get sold this idea that cash is trash and they see it work for 2, 4, 5 years, even in COVID, right? Cash wasn't trash only for a short period of time. And then it went back to being trash again.
Yeah, but then being able to pinpoint those moments when to go into cash
Right.
is
Right.
really what can set you up to be way better than the rest. You know, your portfolio way outperform the others because you're just compounding so much. If you go into cash at every major drawdown, you have that much more capital to deploy into the reversal. So you just compound the portfolio even more. And that's exactly what we do with our model. And that's why it
Right.
works so well.
And there's a reason we're holding 50% cash year to date,
Yeah. And we're going to load the
right?
lows when the time comes.
Right. We're going to pivot out of what we have. Um, and we're hedged for that. So the account is positioned to make money in either a 10% move higher or a 10% move lower. It's positioned to do okay. Right? We're not gonna get smoked in either direction. The real question we're waiting for right now is what is illiquidity going to do? Is the liquidity index going to break lower and really confirm that these times of illiquidity have left us, or are we going to reverse, go higher, and market's going to push lower? Hard to tell, right? But what I can tell you is that the liquidity index is dropping here with the spies on the low still. So that's something to pay attention to. Like if you notice here, every time the illiquidity index drops significantly, SPY puts in a decent reversal.
Yeah. So that's an opportunity right there that's possibly setting up.
Right. If this falls and this can't get a bid, when this rips again, this will puke. That's the idea, right? But it from what I'm seeing at least on Friday, it seems like a lot of people got dump stock and got short real quick on that Powell presser, and they're sitting here right now wondering why the market hasn't gone lower. Me myself am wondering why the market hasn't gone lower. I'm always wondering why the market hasn't gone higher, hasn't gone lower. What's the market thinking from a pricing perspective? And this is completely different from DDAP, right? Remember, take a step back from our whole system, DDAP, the regimes. Understand that the market's organic. It's a living, breathing thing. People, even algos and algorithms are coded by people with hearts and feelings, right? So there's feelings in the market. So if the market goes a certain way, certain people are feeling something. When the market pukes every single day, the bears are getting slaughtered, but eventually the bulls get greedy. I mean, excuse me, the bulls are getting slaughtered and the bears get greedy.
Mm-hmm.
That's what happens.
Yeah. And that's
So,
the cycle of life.
right, exactly. So now we have this puke here and then a move, like I said, and now we're back into this Fed range. So all the bears that press shorts, bought a shit ton of puts, all this whole setup that they put themselves into, this FOMC, maybe they got short prior, right? FOMC is going to shit the bed. Now they have to sit there and wonder, well, why are we not moving lower? At least not last week. Maybe something changes on Monday. But as of right now, we haven't. Now, what happens if this starts grinding higher? Everyone that's short the FOMC presser is now starting to go underwater, and this is where doubt comes in, right? Am I doing the right thing? Am I doing the wrong thing? And that's what ends up happening when you have a low liquidity environment or a high illiquidity index. Is it's kind of like politics, right? The higher this goes, the more split the parties are. The more on one side the bears are, and the more on the other side the bulls are. And what that does
Mm.
is it creates a violent environment in between, right? Which is why we're seeing these 10% counter trend rallies and these 15% dives, or whatever this is from here to here. Not 20% dive, right? 10%, 15% counter rally, 10% dive, 10%. Regardless, you get my point, right?
Yeah. Because
Um,
it's really like all in one side or all in the other.
right.
You start getting that rally, all of the people that got short way too hard, way too over leveraged, they panic, they get out, get a massive squeeze, and then it works just the same way the other way around. And prices are able to move much easier in this low liquidity environment because there's less money in the market. So you're trying to sell your shares, you got to accept lower and lower prices if you want to get filled because there isn't as much liquidity to fill you at higher prices.
Right. And the key to all of this, if you want to break this illiquidity index down to something really, really simple, think of it like a stress index. The higher this is, the more stress there is between market participants. Meaning, um, you know, if you've had a bad day, you come home and something bad happens to you again, you're more likely to blow your top off than if you had a great day and you come home and something bad happens, right? And think of
That's a
that
good way
as
to
like
put it.
the frequency of bad events, the frequency of negative events. They're much higher in illiquidity and a high illiquidity environment. In a low illiquidity environment, think of it as more good times and fewer bad times. Where the other way around is more frequent bad times and even worse bad times, which just pushes everyone in complete. We
Yeah,
have
it's
Twitter.
we're in the times where people start punching holes in their walls right now.
Yeah. Yeah. We have people on Twitter arguing that melt ups. We have people, arguing that the S&P is going to 20 to 2,500. Like it's crazy, right? But that's because there's low confidence in the market. Illiquidity is high. When the illiquidity index goes back down to 20 or anything under 70, I should say, you're not going to hear this bull bear bullshit. You're going to be hearing about penny stocks again.
Yeah.
That's what's going to happen.
Yep.
So just think of it. You can even treat this as the pump and dump index. If this is under 70, pump and dumps will do great. If not, well, you're about to get rugged real bad. So like don't underestimate the power of the market when there's not enough when the sides aren't close enough. When the sides are close enough, you have something that would seem as an orderly bid and an orderly sell, right? And this was what I'm talking about is this, right? We have the market going higher, even after COVID, orderly bids, right? Orderly sells, illiquidity comes up, it comes down, comes up.
That's
It's
price
it's dynamic.
stability right there.
Price stability.
That's what the Fed is after.
Right. And now look at us. We're right here. We're going, illiquidity index is moving almost 30 something points off the August lows up to the more than 30 points, almost 40 points, all the way up to the September highs. And now we're back in basically the midpoint. So illiquidity is all over the place. Don't go in thinking that um it's the time it's the environment that is gonna, it's generational lows or whatever the fuck they're trying to tell you on Twitter. Just understand that the market is in a position where volatility has to be accepted at a higher rate, meaning VIX 25 is acceptable now. Okay. Back when the illiquidity index was down in the 30s, VIX 25 was seen as like a tail event.
Hmm.
So you have to understand that the liquidity index is telling you that VIX this high is normal for this environment. If anything, VIX should be higher. Historically, they track each other quite well, but I'm assuming that there's just so much confusion on what's going to happen that the market is having a tough time going anywhere, which is keeping that VIX low. If the market were to start shitting the bed hard, VIX would go up. But again, it's seeming like the illiquidity index is on its way down. So do these meet lower, or does the illiquidity index go down or VIX go higher? That's the big question we're going to be watching for in the coming weeks. But remember, the market has priced a lot of things in. We're pricing in a 5.25 terminal. ES is still 3780. So just think about this. Does it turn? What could push the ES lower? Well, higher terminal, and that's what inflation not doing. Do I think the terminal has upside room? Yes. Does ES have downside room? Yes, on my belief. But do
It's not going
could
to
it
get there in a straight line, though.
Right, right. Could we get a 10% inflationary counter trend rally where you do a bull trap? Yes, that's totally possible. That's what I'm hedged for that specific reason. Now, if that doesn't happen, oh well. But if it does, it gives us the opportunity to be just even more dynamic. We added shorts up in August, up at Momo on ES here. We added shorts here. If we can get another move up there, it'd be a great place to add shorts again, as long as the risk off regime does continue. But I think that's where we're going to finish it off today. If you like the podcast, please like, subscribe, share with your friends, share on Twitter. All of our models and our daily reports are on our website at www.market-radar.com. And if you want to follow us for daily updates on Twitter, our Twitter handle is at the Market Radar. Thank you so much, guys. Have a great week.